Hey everyone, welcome back to Corporate Decoder, the place where we untangle the financial mysteries of big companies. And today we're looking at Morgan Stanley Direct Lending Fund. And boy, this report has some interesting little tweaks in it. So, Morgan Stanley Direct Lending Fund, or MSDL as you might see it on the stock market, has filed a Form 8K. Now, an 8K is like a special bulletin. It is filed when something important happens that the company doesn't want investors to wait for their regular financial reports to hear about. Think of it as a company shouting from the rooftops because something significant just went down. And what happened here is that on the 24th of September 2025, a subsidiary of the fund called DLF LLC, which is basically a part of Morgan Stanley Direct Lending Fund, signed a new amendment to an existing deal. This deal is called a Revolving Credit and Security Agreement, and it is with BNP Paribas. Now, what is a revolving credit agreement? Think of it like a credit card for a business. It is a flexible loan facility where they can borrow money, pay it back, and borrow again up to a certain limit. It is a crucial part of how these lending funds operate, allowing them to manage their cash flow and invest in new loans. This latest tweak is actually the 6th amendment to this agreement, so they've been adjusting it over time. What has changed this time around? Well, the main thing is about the cost of borrowing. They've managed to get a better deal, which is always good news. Specifically, the interest rate they have to pay on their borrowings has gone down. During what they call the reinvestment period, which is a time when they are actively putting money into new loans, the interest rate margin has been reduced. It went from 2.25% down to 1.95%. That might sound like a small change, but when you are dealing with millions or even billions of dollars, those fractions add up to significant savings. And even after that initial reinvestment period, the margin has also been lowered from 2.75% down to 2.45%. So across the board, they renegotiated a better rate on their credit facility. This is a smart move, especially in a fluctuating interest rate environment. It means more of the returns from the loans they make can flow to the fund and ultimately to its investors, instead of going to the bank providing the credit. This agreement is with BNP Paribas, a major global bank, acting as the administrative agent, and it also involves US Bank Trust Company, National Association, as the collateral agent. Collateral agents are important because they ensure that anything pledged as security for the loan is properly managed. It all points to a well-structured and reputable financial setup. It's important to remember that Morgan Stanley Direct Lending Fund itself isn't the direct borrower here. It is a wholly owned subsidiary, DLF LLC. This is a common structure to keep things clean and manage risk. The fund is acting as the equity holder and servicer, meaning it is the owner and also manages the underlying loans that are part of this facility. The fund's common stock, you'll find it traded under the ticker symbol MSDL. On the New York Stock Exchange, this filing is essentially a note that a key financial arrangement has been adjusted favorably. Now let's talk about the money part, or rather the cost of money part. This 6th amendment is filed as Exhibit 10.1. While we don't have the full profit and loss statements here, understanding the cost of capital is crucial for a lending fund. Lowering the cost of borrowing directly impacts their profitability. If they can borrow money for less and then lend it out at a higher rate, the difference is their profit margin. And who signed off on this? David Pessar, the Chief Financial Officer. This is typical. The CFO is responsible for overseeing the financial health and reporting of the company. The date of this report is the 29th of September 2025, meaning the news broke just a few days after the amendment was signed. Transparency is key in the financial world, and this filing demonstrates that. This amendment also falls under Item 2.03 of the 8K, which deals with direct financial obligations. It confirms that this is just some casual chat. It is a formal, impactful financial agreement that creates or modifies a direct financial obligation for the company as subsidiary. So, what does this all mean for investors on the surface? This is positive news. A reduction in borrowing costs for a lending fund is generally a good thing. It suggests the fund is in a strong enough position to negotiate better terms, or that market conditions have improved for such facilities. It implies a greater potential for higher net returns from their lending activities. However, it is also important to remember that this is just one piece of the puzzle. The overall health of the fund depends on the quality of the loans it makes, the interest rates it charges on those loans, and its ability to manage any risks associated with its borrowers. This filing doesn't give us the full financial picture like revenue or net income. Those details would typically be found in their quarterly 10Q or annual 10K reports. But what it does tell us is that a fundamental part of their financial engine, their borrowing capacity and cost, has been optimized. As a lending fund, their success hinges on the spread between what they pay to borrow money and what they earn by lending it out. By successfully lowering the cost of borrowing, Morgan Stanley Direct Lending Fund has effectively widened that spread, at least on this particular credit facility. This is a strategic move that can enhance profitability and potentially allow them to compete more aggressively in the lending market. One thing to keep in mind for any lending institution is the broader economic climate. If interest rates rise significantly, or if there is an economic downturn leading to more defaults on loans, even a lower borrowing cost can fully insulate the fund from problems. However, the fact that they are actively managing and renegotiating these facilities suggests a proactive approach to financial management. In conclusion, this 8K filing signals a positive operational adjustment for Morgan Stanley Direct Lending Fund. The lower interest margins on their credit facility with BNP Paribas are a concrete benefit that should bolster their profitability. It shows a company that is actively working to optimize its financial structure. While this report doesn't provide a deep dive into their lending portfolio, performance, this amendment is a solid step towards improving their bottom line. Alright, that is our breakdown of Morgan Stanley Direct Lending Fund, latest filing. What is your take on these numbers and what they signal for the company future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord linked in the description. Thanks for watching. See you next time.